If a politician proposed a new tax, one that automatically hit the poor harder than the rich, required 0 votes in Congress, and kicked in whether the economy was good or bad, would you support it? Of course not. But that tax already exists. It's called inflation. And it's been running quietly in the background of your financial life for your entire lifetime. The wealthy figured this out decades ago. They built legal escape routes. And most people, the ones paying this tax the hardest, have no idea it's even happening. Today we're going to change that. Before we can talk about the inflation tax, we need to get one thing straight about money. Most people think of money as a thing, something real, stable, permanent. A dollar is a dollar. But that's not what money is. Money is a claim on real goods and services in the economy. A dollar doesn't have value in itself. It has value because you can exchange it for something that does. Now here's where it gets interesting. Governments and central banks can create new money, not by printing physical bills, that's mostly a metaphor, but by expanding the money supply through bond purchases, lending programs, and other mechanisms. When they do this, they increase the number of claims floating around the economy without increasing the actual goods and services those claims are competing for. More claims chasing the same stuff. What happens? The price of the stuff goes up. That's inflation, in its simplest form. And here's the key insight. When the government creates new money, it effectively transfers purchasing power from everyone who holds existing money to whoever receives that new money first. The first recipients, banks, large institutions, government contractors, get to spend it before prices adjust. By the time that money trickles down through the economy, prices have already risen. Everyone else pays more. Their savings buy less. That transfer? That's the tax. Let's be precise about this, because the word tax is doing serious work here. A traditional tax is visible. You see it on your paycheck. You feel it on April 15th. Politicians have to vote for it and defend it. The inflation tax is invisible. Nobody sends you a bill. No politician has to go on record. But the effect is identical. A portion of your wealth is quietly transferred away from you. Economists have a name for this: seigniorage. It's the profit a government earns from creating currency. When the Federal Reserve buys government bonds by creating new money, the U.S. Treasury effectively gets to spend resources it hasn't taxed or borrowed in any traditional sense. It's spending funded by diluting the value of every dollar already in existence. Think of it like a pizza. You own 4 slices. The government quietly adds a 5th slice, but instead of baking a bigger pizza, they just cut yours thinner. You still have 4 slices. But each slice is smaller. The government ate the difference, the cruel math. The people this hits hardest are the ones holding the most cash relative to their wealth. And who holds the most cash relative to their wealth? Working and middle-class people. People with checking accounts, people living paycheck to paycheck, people who were told to save your money and did exactly that, only to watch those savings lose 20%, 30%, 40% of their purchasing power over a decade. Here's where the story gets genuinely infuriating. Not because the wealthy are doing anything illegal, but because the system was designed, consciously or not, to protect them. The escape from the inflation tax comes down to one principle. Don't hold cash. Hold assets. Assets, stocks, real estate, businesses, commodities, private equity, tend to rise in price during inflationary periods. They're claims on real things. When the money supply expands, the number of dollars chasing those assets increases, so their prices go up. If you own a rental property worth $500,000 and inflation runs at 7% annually, your property is likely worth $535,000 the next year. Your wealth kept pace? Maybe it grew. If you have $500,000 in a savings account earning 0.5% interest during that same year, you just lost roughly $32,500 in real purchasing power. You didn't spend anything. You didn't invest poorly. You just held cash, and the inflation tax collected its fee. Now consider what the wealthy actually own. According to Federal Reserve data, the top 1% of Americans own roughly 54% of all stocks and mutual funds. The top 10% own over 89%. Meanwhile, the bottom 50% holds negligible stock wealth. Real estate? Similar story. The wealthy own it. The working class rents it, paying prices that also rise with inflation, with none of the asset appreciation to offset it. So the inflation tax creates a brutal double hit for people without assets. Their savings lose value, and the prices of the things they need, rent, food, gas, go up. The wealthy, meanwhile, see their assets rise. Inflation for them can actually increase net worth. This is not an accident. This is the structural logic of holding capital versus holding cash. Let's get specific about the tools the wealthy use. Tools that are entirely legal, available in principle to anyone, but practically accessible mainly to those who already have resources. 1. Equities and index funds. The stock market, over long periods, tends to outpace inflation. Historically, the S&P 500 has returned roughly 10% annually, well above most inflation rates. The wealthy park enormous sums here. The working class, living paycheck to paycheck, often can't afford to lock money away for decades. 2. Real estate property is a nearly perfect inflation hedge. Values rise, rents rise, and mortgage payments, if fixed rate, stay the same, meaning the real cost of the debt shrinks over time. The wealthy use leverage to amplify this. They borrow at today's dollars to buy assets that appreciate and then repay loans in tomorrow's devalued dollars. Inflation literally helps them. 3. Treasury inflation-protected securities. Tips. The government actually sells bonds specifically designed to protect against inflation. The principal adjusts with the Consumer Price Index. The wealthy know about these, most people don't. 4. Commodities and hard assets. Gold, silver, oil, farmland, physical assets with intrinsic value. These tend to hold purchasing power when paper currency weakens. Again, accessible in theory, but practically the domain of sophisticated investors and institutions. 5. Business ownership. If you own a business, you can, to varying degrees, raise your prices to match inflation. You pass the cost to your customers. Workers, by contrast, have to negotiate for wage increases, a process that often lags inflation by months or years. That lag is, again, a hidden tax on labor. Let's talk about something that makes this even more unjust. Even when wages do rise during inflationary periods, they almost never rise first. Asset prices adjust quickly, sometimes instantly, as markets are forward-looking. Rents adjust at lease renewal. Food prices adjust at the shelf. But wages? Wages are sticky. They require negotiation, contract cycles, employer decisions. Workers are chronically behind the curve. This means that during an inflationary surge, there's always a window, sometimes months, sometimes years, where workers are earning yesterday's wages while paying today's prices. Economists call this the inflation tax on labor. It's a real and measurable transfer of wealth from workers to employers and asset holders. The wealthy capture gains on the way up. Workers absorb losses on the delay. Every time a government debates stimulus, quantitative easing, or expanding the money supply, there is a distributional consequence. New money doesn't land equally. It flows through existing channels, financial institutions, asset markets, government programs, and it hits everyone differently depending on what they already own. Inflation is often called a hidden tax in economic literature. But it's more insidious than most taxes because it requires no legislation, no vote, no accountability. It can be implemented by unelected central bankers responding to economic conditions, with no requirement to acknowledge who bears the burden. And the burden, as we've seen, falls hardest on the people with the least. This doesn't mean all monetary expansion is wrong. Sometimes it's necessary during financial crises, recessions, pandemics. But it means we should be honest about the costs and who pays them in a way that our public discourse rarely is. Calling inflation transitory or blaming it purely on supply chains is easier than saying we created money and people who don't own assets paid for it. So where does this leave you? Knowledge is the beginning. Understanding that inflation is a form of taxation, regressive, invisible, and structurally favorable to the wealthy, changes how you evaluate economic news, policy proposals, and your own financial decisions. The practical takeaway is uncomfortable. Holding cash long-term is a guaranteed slow loss. The assets that protect against inflation, stocks, property, inflation-linked bonds, require either capital or time that many people simply don't have. This is the real inequality story hiding beneath the headline numbers. It's not just that the rich have more. It's that the system of money creation, by design or by consequence, continuously transfers wealth from those who hold cash to those who hold assets. The wealthy didn't create inflation, but they read the rules. They built their portfolios accordingly. And every year, quietly, legally, the gap widens. The question isn't whether this is happening. The question is whether enough people understand it clearly enough to demand something different. Thanks for watching. See you in the next video.